Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And guys, today I'm excited to welcome back another returning guest, someone that's that's a thought leader and as well as a seasoned investor in the commercial real estate space. That's Paul Moore. It's been a number of years since we've had Paul on, so I wanted to bring him back and figure out what's going on in his world. For those that don't know, Paul is the founder and managing partner of Wellings Capital, which is a firm that helps passive investors gain access to high quality commercial real estate deals across many different recession resistant asset classes like self storage, mobile home parks, light industrial, and multifamily housing, amongst others. Now, today we're going to take some time and dive into Paul's approach to building long term wealth. Really his take on what's going on in the current market cycle and how they're handling things, and then what Wellings Capital is doing differently in today's somewhat challenging environment. We've had a couple years of challenges with interest rates on the rise and what have you. And so, guys, without further ado, I'd like to welcome back my good friend Paul Moore. My friend, how you doing today?
Hey, it's great to be here, Kevin. I'm doing
Yeah.
great. How about
Yeah,
you?
no, excited to have you back. Always excited to talk shop with you. Like I said, it's been a few years. I think probably midst of COVID last time that we caught up, but so excited to have you here. There's been a lot of things that have evolved and changed over just the last couple of years. So excited to kind of dig in and learn a little bit more about what you're up to today. But I'd say, Paul, before we go down some rabbit holes here, for those that are tuning in that might not be familiar with who you are, your background, the backstory of it all, maybe take a few minutes and just fill in any of the blanks for me, from that brief introduction I gave you.
Yeah, well, I mean, if I go way back, I started out with an engineering degree, which was a big mistake for me. I'm more of a marketing type person and people person, and I did well in engineering, but and got MBA, went to Ford Motor Company 5 years, had my own company 5 years, sold it to a public firm, and you know what? I thought I had a couple $1 million in the bank, and I thought, hey, I'm a full-time investor now. And the truth is, I was not. I was a full-time speculator, is what I was. I didn't know the difference. And I made a ton of mistakes and I lost a lot of money. In fact, I was the host of a show for 4 years that you're familiar with called How to Lose Money. And we talked about painful mistakes that we all made on the way to hopefully eventually succeeding. During that show, I flipped from multifamily to getting involved in mobile home parks, self-storage, and other asset types. And since then, we've launched 8 funds for investors who want diversified commercial real estate. So that's what we do.
All righty, fantastic. No, I appreciate the background there. So, how about just Wellings Capital? The general your general investment thesis. I know you mentioned multiple different asset classes you guys involved in over the years. I know self storage and mobile home parks are two of the favorites, but you've got a number of others that you guys are focusing your efforts and energies on. But just I guess backing up from a 10,000 foot view, just the investment thesis around those various asset classes that you guys are focused on.
Yeah, well, the thesis comes down to me to the Pareto curve. And some of us know who Perry Marshall is. Perry Marshall was an internet guru. He also wrote a book called 80/20 Sales and Marketing, and he explained that the 80/20 curve is also known as a skew curve. So it goes up and to the right. And the average investor invests in the average operator with the average deal. That's what makes them average. And they get a certain result. And during the decade following the great financial crisis, that result was amazing because the more operators, the more risk they took, the more returns they got when they flipped their deals in a couple years. And that's, you and I talked probably 8 years ago about, that's why I got out of multifamily because
Mhm.
it wasn't making sense. It felt like musical chairs and, at some point the music was going to stop. The skew curve also says, though, that the 80/20, the top 20% of the operators do that get the top 80% of the profits and all that stuff. Well, the that top 20% or even the top 20 of the top 20%, in other words, the top 4%, get far, far higher and more importantly, safer outcomes than the average. I mean, way higher. And so the problem is Warren Buffett said, like the rising tide lifts all boats. And that's what happened from 2012 to 2022. But he said one day that tide will go out and then we'll see who's skinny dipping.
Mhm.
And the 11 interest rate hikes that happened in 13 months or so actually was the kind of the signal of the tide going out. I won't call it the tide itself because the problems were much deeper than that. But the rising interest rates, actually proved who was skinny dipping. All
Mhm.
kinds of stuff went bad from 2022 to now. Here we are 3 years and 3 months later after the first interest rate hike. There's still a lot of carnage, a lot of extend and pretend that's still going to fall out, especially in multifamily. But mobile home parks, so many other asset types have not experienced the pain that multifamily often has. I won't say all the time. And then there's great operators. Again, if you use the 80/20 rule, we have operators like you, Kevin, who, you're doing things right and your investors are happy and, you're buying from mom and pops and there's so much more meat on the bone and therefore so much safety for investors. We just love mobile home parks and asset types like that.
Yeah, no, no, we do as well as you know, and I appreciate that. I guess self storage is one of the asset classes. Would love to maybe poke that one a little bit. And I love self storage. I've got personal investments there, but it's got a little bit more price sensitivity, more specific to like the last couple of years, right? Because self
Yeah,
storage was one of the asset classes that capital was flowing readily. Lots of private equity and institutional capital trying to work its way into that sector. Not necessarily the same types of barrier to of entry that mobile home parks have. Much more price sensitive in nature as well, especially in markets where lots of product was being built.
right.
Just curious as to your perspective on self storage today, or what your perspective is today, and then also how have the last couple of years played out in that sector.
Yeah, it was obvious to many of us. I mean, I wrote a book on self-storage published by Bigger Pockets in 2021 called Storing Up Profits. And it was obvious even then that the asset type was getting overbuilt.
Hmm.
I could drive you all over Nashville where I did due diligence once and show you why it looks like it's overbuilt with lots of new assets on lots of different corners. I could also take you 10 or 15 miles south of Nashville to a booming suburb. There's Bellevue, there's Belleville, there's another suburb I can't remember the name of, and there's hardly any self-storage at all. It's extremely, under the price, the values are really high, the occupancy is really high, and it's really hard to get a new storage facility there. So it is very much, I call it micro local. We've made massive profits in deals in places like Ishpeming, Michigan, population like 3,000 in the Upper Peninsula, where there was no self-storage, to speak of for many, many, many miles around.
Hmm.
And places like Beeville, Texas, population 12,000.
Wow.
Uh, Again, it's really not it's not just how you buy. You've got to operate really well, but it has a lot to do with the type of seller. And as you well know, a lot of mom and pop sellers don't have the desire or the resources or the knowledge to improve their properties, to get all the value add, and therefore maximize value. And self-storage is like that. I mean, think about self-storage, the value adds. There's 6 acres out back we don't use, and the buyer smiles and says, okay, thanks. And of course, they gravel or pave it and turn into industrial storage, boat and RV parking. They might build more units there. They can sell locks, boxes, tape, and scissors. They can put a cell tower in the back, a billboard in the front, a propane filling station, an ATM machine, all kinds of stuff to add value to self-storage. And one thing I love about it too, the thing that first sold me was if you've got a $2,000 a month apartment and the rent goes up by 10%, you might move rather than pay 200 extra a month. But if you have
Hmm.
a $150 storage unit and it goes up 10%, you're probably not going to spend a weekend, get a U-Haul, get your friends together to move your junk, sorry, your treasures down the street just to save $15 a month.
Yeah, yeah, no, I agree with that. It's interesting. It's been many, many years since I've used a self-storage facility, but there was an office we had shut down. This was probably 20 years ago, and we moved all those contents, desks, filing cabinets, computers, all that into the self-storage unit, and we went ahead and paid that bill. Like number one, we hated the day that we moved it all in there. It was just a pain in the ass. We did it ourselves, and it was a pain in the ass. We shoved it all in, closed the door. 8 months go by, a year go by, a year and a half. I talked to my business partner. I'm like, hey, what are we going to do with that? He's like, I don't know. I just would rather keep paying
Yeah,
$130 a
right,
month,
right,
whatever it
right.
was. At that point, we were so far into it that what we had paid in the storage fees probably exceeded the value of the contents inside. But even then, the contents inside, in order for us to stop that monthly fee, we'd have to go take proactive action and actually go sell the
Yeah,
stuff, right? Put it
right.
on Craigslist or whatever. And I'm like, I'm not doing that. I'm not taking the weekend to do that. So
Yeah,
we continued paying that fee for probably 4 years before we finally just said, enough's enough. But anyway,
right,
to your point, folks do not like moving their junk, that is, their treasures.
right.
So maybe speaking to the last, 12 to 24 months, specific to your business, again, rising rates where we're at in this, still inflated interest rate environment. There's been quite a bit of uncertainty on a broader macro scale. Inflation is tampered down a bit, but obviously ran rampant for a number of years. And just curious to know some pivotal changes that you've made in your business. How do what's it look like through your lenses today compared to what it looked like 24 months ago?
Well, when interest rates were really going up, we were actually just a common equity investor, which meant our investors could actually go around us if they wanted to and invest in the same things we were. We might get better terms. We often did. But we began structuring preferred equity deals. And these were not rescue deals, never, but they
Hmm.
were, like an example, the most recent one we looked at, the sponsor had put in 6.5 million of their own money and the rest was debt. Now they want to go buy something else. Well, they're like, hey, you know what? We would like to pull 5 million of that 6.5 million out, but we're not ready to refinance. And so they pay us something on order of, say, 15, 16%. Um, and that might be like a 9% current pay and a 6.5% upside, which is accumulating, compounding, payment in kind, as they call it, PIK. And that gets paid off when they refinance or take us out or sell the property. And so we did that for 2 or 3 years. We had a lot of multifamily deals in there. And then we realized, we're coming back into a really optimistic time again. It looks like we don't know. We'll never know till we see in a rearview mirror, but we might have hit a bottom and don't know yet. But it looks like there's a lot of upside on a lot of deals we're looking at. It'd be nice to capture some of that upside instead of being limited to the 15.5% or so. And
Hmm.
so we started doing JV hybrid equity more recently. We call it that. It's JV equity because we're bringing the largest check. So, like on a $51 million multifamily recently, there was 30 million in debt, 21 million in equity. We brought almost 15 million of the 21. So we're the largest investor by far. We call it JV for that. We call it hybrid because it's a hybrid between pref equity and common. It's got some of the downside protections of pref equity. It's lower in the capital stack. It's not taking the first dollar of risk. The 6 million common and GP was taking the first risk, and then it would get to us if the property value dropped by over 6 million, but only then. Um, but we got unlimited upside like common equity. And so that's what we're doing more of now. And it gives us forced sale rights, management approval rights, all kinds of, purse string controls. And of course, we don't want to use any of the egregious ones. We try to pick operators who we'd never have to worry about in that regard. But
Yep.
that's our way forward from now on, Kevin. We plan to do some pref equity, especially in our income fund, and a lot of this JV hybrid equity in our growth fund.
Is the growth fund, is that strictly existing properties, or is there development in there as well?
Kevin. We could do development. We're not looking at development right now, but if we found a sponsor who had 10 or 20 years of just stamping out development deals
Mhm.
and it was a fit, we would certainly look at it.
Got it. Got it. Well, let's talk about the sponsor side of things. I think that's where a lot of passive investors today are just, they've been shooken up a little bit over the last couple of years. You and I both know many folks that have lost money in other investments,
Yeah.
sponsors that have gone, just off the rails, for
Yeah.
various reasons. So talk to me about, how, kind of your process of identifying a solid sponsor, what you're looking for nowadays. What really helps an individual sponsor rise to the top of the stack when you're seeking a new investment opportunity.
Yeah, well, frustratingly, we looked at 745 deals last year, and we've got a growing team of people. It went from Ben and I, my partner, to Troy, and then we've added three more people on Troy's team. So he has a team of four. But frustratingly, we looked at 745 operators and deals last year and only invested in five.
Wow.
We're looking for sponsors who have, a cohesive team that's been working together a while. They've gone full cycle on a lot of deals. They've got, really good history. They don't have, we do a deep criminal check,
Hmm.
background check. We actually spend $10,000 to do a net operating income audit.
Hmm.
And that NOI audit, it doesn't come out of the investor's pocket at all, but it allows us to see if what they or the seller usually is telling us is true about where the income comes from. We do reference checks. We do death by Google. We fly out to meet them at the headquarters. We check out, our gut feel on what they're saying. Is there a funny gut feel here? How do
Hmm.
they treat their wife or their husband, or how do they treat their investors and employees? What do employees who have exited say about them? We recently spent $13,000 again, not out of the investors, out of our pockets, doing a kind of a really deep dive background check, interviewing eight or nine employees who had left a company to see what they were saying. I mean, stuff that
I love that.
every investor would probably love to do. They just don't have the time and the resources to do it. And we do that on behalf of investors since this is our job to screen these operators.
Yeah. Interesting to know out of the 765, you said only five that you actually that kind of rose to the top that you put some money and resources into.
Yeah.
Was that the case that you did deals with?
Yes, 5 out of 745.
Were there any that 700 plus that ultimately that you started going down the path and realized very quickly that just for XYZ reasons, this was not going to be a fit?
Yeah. The vast majority of those, Kevin, probably
Okay.
didn't last 5 or 10 minutes in our
Right.
process, but some went 3 months. And we had a deal. Now, this is 2 years ago now, but we had a deal that went to closing. We wired the money. And we had a few misgivings. I'm going to be really honest. And I hate to say that now, but I mean, at the time, our investment team was one. It was Troy, and then Ben and I were helping him. Now we have four on his team. But honestly, I just had a few gut checks that I overlooked because I did the site visit with them. And at closing, literally, they tried to change the terms of the deal significantly.
Oh
And
wow.
so we told the closing attorney, wire our money back, and we were done. And I'm so
Good for
glad we
you.
walked. I'm so glad. We had a big discussion last week. What if we do sidecar deals as well?
Hmm.
We have a mobile home park sidecar deal we just did. We have another one we're looking at. We said, what would happen if we raised, let's say, 5, 6, 7 million in cash? It had already been wired from investors, and then something turned up really bad in due diligence. And we said, look, we are absolutely committed. We are not we cannot let the fact that money has been wired change our decision. We just can't. And it takes some discipline.
Yeah. Yeah, I think it's easier to have the conversation's tough on any level there, right? Like, the right move to make would be to have the difficult conversation with the 1, 2, 3, maybe 30, 40, 50 investors that wired their money and that had expectations set, right? They've
Yeah.
earmarked it. They've spent time and energy, discussing the opportunity with you. They're sold on it, right? They've wired the money over. It's a very difficult decision to reverse that, right? You upset folks, you might not get that money back. It might go into another investment,
Yeah.
but that is absolutely by far the best approach to take because again, those that I think the investors that rise to the top there, that might be a little disappointed will identify you as a stand-up individual making the right
Right.
decisions and ultimately being a steward of their capital, which is the position that you're in. So
Right.
no, I agree. I think that's part of what ultimately played out as well with maybe some of the, you'd mentioned you kind of stepped out of the multifamily space. It just didn't make sense anymore, right? It was kind of a musical chairs game, and I think it's there was so much capital flowing. It's you got to be incredibly disciplined to turn away capital, but I
Yeah.
don't think a lot of folks were, right? It was like, hey, the money's here. We've got folks that are throwing millions of dollars our way. Let's find a home for it. And
Right.
then that goes to overpaying, that goes to going into secondary tertiary markets, that goes to buying C grade assets and the less desirable part of town, thinking that I can just
Right.
you know put a little bit of polish on it, a little bit of lipstick, and raise rents by 20, 30% and get this model to work. So anyway, I think now we're seeing that get all flushed out, but it's
Yeah.
going to be a number more years before we see really what the carnage really looked like. Because as you had mentioned,
Right.
there's lots of extend and pretend that's still taking place today.
Right.
So,
Absolutely.
Paul, you talk a lot about the boring investor. I know that I've heard a number of segments that you've done on that topic. So maybe let's take a few minutes. What does that mean to you?
Yeah, so I made a huge mistake. I mentioned being a speculator 25, 27 years ago when I sold my company. I wanted this, I didn't know it at the time, but I wanted to get the same excitement out of my investments that I did out of being an entrepreneur. And, basically, so I loved the thrill of the chase.
Hmm.
I loved repeating the learning curve over and over. I got a rush out of the being in startup mode. All those things that, people who do tech startups. I wanted that out of my investments. I didn't know that, the smartest investors were the boringest investors. Warren Buffett, I don't know that many of us could stand to live 1 week of his life. I mean, it is so boring. I mean, he gets, yeah, many of us have heard about his routine. Just go look it up. It's unbelievably boring. Paul Samuelson, the first U.S. economist to win the Nobel Peace Prize, said investing should be boring. It should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That's what he said. And I didn't believe that until I lost a lot of money and made a lot of mistakes. But I found out, that boring investing, you enjoy true freedom. You're not chasing, constantly making new decisions, constantly in and out of positions, constantly checking your, price on GameStop or your options or whatever. I mean, one of the most exciting investors of all time, the founder of day trading, basically he couldn't even replicate his own success. And in fact, he took his own life in after making like 2 or 4 billion in today's dollars, shorting the stock market right before October of 1929. But then you've got people like Warren Buffett who said, I would rather invest in Wrigley's gum than your tech startups. And this was in 1999, right before the tech bubble crashed. He said, I'd rather invest in Wrigley's gum. I know how people will be chewing gum in 10 years. I don't know where the internet will be. And it's basically just a thing of basically being willing to be boring, to go slow. Jeff Bezos asked Buffett, he said, "Hey, your strategy's not that complicated. Why doesn't everybody just imitate you?" He said, "No, no, nobody wants to get rich slow."
That's true. Yeah, I love that. I mean, was that part of the catalyst? I mean, just that philosophy, is that part of the catalyst of the recent evergreen fund that you've launched?
Yeah, yeah, that's it. In fact, our first investment in the Evergreen Fund, I can't even get a story to tell investors. It's so boring.
Yeah, so talk to me about maybe the feedback that helped drive that decision. So this is this the second, so I understand correctly, this is the second evergreen fund or the first?
No, this is the first Evergreen
Evergreen.
Fund.
Okay. Yeah, so I would
We've
love
done
to know
them
the feedback that you've received from because now you've done, I think you mentioned eight funds
right.
that you've done now over the years. Obviously, trying to always make decisions based on feedback of your investor base, trying
Yeah.
to continually improve for them. What was it? What really was the catalyst there then to launch this evergreen fund since it's now a somewhat very different than that of what you've historically offered?
Well, for one thing, we have investors who say, hey, I like the 10-year hold. We have a few investors who say, I wish it was forever. Warren Buffett said my ideal hold time is forever. And
Hmm.
some of our investors believe that. But others say, hey, I'd really want the optionality of getting out in 4 or 5 or 6 years. Can you provide that? And we said, no, not in a 10-year fund. So the Evergreen Fund, one benefit is it gives people a chance who want to be in forever. It gives other people a chance to be out in 4 years. It gives other people optionality to get out if they need to along the way. It's an income fund, which means we're only investing in income producing assets. A lot of those are pref equity, like I mentioned, that might have a 9, 10, 11% current pay. And there's not a lot of appreciation, but there's not a lot of drama either.
Hmm. Yeah, no, I love that. I love that. Um, what else? What else, Paul? What else is going on in your life? I mean, talk to me about, the next 12 to 24 months. What are you most excited about? What keeps you up at night in a good way? I know you had mentioned that you feel like we're kind of entering into what might be an opportunistic environment. We might have hit the bottom. We'll know, years from now, we'll look back and realize whether we did or didn't and what date that really happened. But just generally speaking, I mean, what are you most excited about over the next 12 to 24 months?
Yeah, well, I'm in addition to the Evergreen Fund, I'm excited about the Growth Fund. We already talked about that. And that
Yep.
one is for people who don't need income, but they want to get, mid-teens, maybe even high teens, total returns. And those would be, steeper value add deals. They could be some development deals. It would be, more of let's say a mobile home park deal that was you might think you wouldn't, but some people might think sounds stupid because it was bought at a three cap, but it was extremely, extremely undermanaged, poorly managed, undervalued, had, let's say 50% vacant lots and that's of course, your listeners know this, but one of the big benefits to mobile home parks is a lot of mom and pops won't fill those vacant
Hmm.
lots, but a professional operator like you will bring in new homes, fill those lots, and significantly increase income. And so those opportunities might, not be cash flowing for the first year or two, but
Hmm.
then have incredible growth on the other end. The affordable housing crisis, as we all know, is real. 10,000 people turn 65 today, but 6,000 of those 10,000 don't have $10,000 saved for retirement.
Hmm.
Many of them, through, their own choice or necessity, are willing or happy to move to a mobile home park and greatly reduce their expenses. They get their own parking spaces, they get their own deck, they get a yard, not a huge amount of maintenance, the opportunity to travel. They don't have to share a wall with a neighbor.
Hmm.
I know a wealthy doctor who chose to move to a Palm Springs, California
Yeah.
mobile home park. He didn't have to, but he wanted to, and he got a chance to travel and have a lot of flexibility. So the affordable housing crisis is driving, and the multifamily shortfall in general, combined with that, is driving massive potential for people who will be smart in this next cycle and not take stupid risks and, do a lot of the things that a lot of people screwed up in, the last 10 years.
Well, it's for the LPs. How about the LPs that are that might have lost some money in a few investments that went sideways over the last couple of years? That they're sitting on the sidelines now, debating what next steps are. I mean, any advice that you would give to them about market timing versus just getting back into the market, right? Time in the market. I mean, what would you say to them?
I would really say, again, back to the Pareto principle, the 80/20
Yeah.
rule, if you can take the time, effort, or align yourself with somebody who does, who really, really can pick the best sponsors and who, did really well in the last cycle, maybe you won't have to fall prey to those issues again, like some of the things we talked about that, went really, really south and even some cases turned out to be Ponzi schemes.
Yeah.
Um, they're not all that way. And a lot of people, like an investor who traveled to my office today from Dallas, said, while a lot of my friends lost a whole lot of money, several of us invested in places like our company that never missed a beat, never lowered a distribution,
Hmm.
and had no problems at all during this, downturn. And it is possible to do that.
Yeah, no, I agree. Well, Paul, always appreciate you coming on. And, as we round this out here, I guess one last question. If you could go back in time and give your younger self one piece of either, investing or just general business advice, what would that be?
Yeah, one of my business partners actually ran for governor of Colorado back in the late teens, probably 2017, 18, and he, rubbed shoulders with billionaires and others. And he said, you know what? He said, they're not like their education wasn't that much better than ours. Their opportunities weren't that much better than most of us, but they found one lane and stayed in that for decades.
Hmm.
And there's so many case studies on this, including Buffett, including Bill Gates. They stayed in one lane for decades. They plodded along. They were willing to be boring. They said no to 10,000 distractions, as Gary Keller said, to say yes to their one thing. And therefore, they had so much more success. I was a certified shiny object chaser, Kevin, and I would tell myself, and if I could have somehow had the wisdom to say, get involved in commercial real estate in your 20s and stay there, that's what I would have done.
Got it. No, I love it. Certified shiny object chase. That's the first. Good stuff, Paul. Always a pleasure to have you on. For those that want to learn more about Wellings Capital, about the opportunities that you guys have and the offerings, where's the best place to find you?
Yeah, you can go to our website, Wellings Capital. That's Wellings, wellingscapital.com. And we've got free special reports on lots of asset types, including mobile home parks at wellingscapital.com/resources.
Alrighty, my friend. Appreciate you coming on the show.
All right, Kevin, great to be here.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.